Hey folks, welcome back. Here's an update with my options challenge with Alphabet, and it's earnings week, so that's really exciting. And I'm going to talk about how that's going to change my options trade for this week. But first, let's go over what happened last week because it was pretty interesting. It was my first week of doing this challenge. And if you remember, I sold two 108 puts and I sold two 120 calls. And the idea was by the end of the week on the 22nd, I wanted Alphabet to close somewhere between these two numbers here. And at the end of the week, Alphabet closed at exactly 108, pretty much closed the day at 107.9. But then in after hours trading, it went above 108. It was like 108.05 or something like that. So at the end of the day, one of the option holders decided to exercise, and then the other one decided to let it expire worthless. So that's not something you would see every day, but I ended up with 100 extra shares of Alphabet. And the capital used for that, this is all in Canadian dollars, is 4,179. And the options earnings I made last week was 232. And the way I calculated that number is basically just take my options trade here. So I have the Alphabet call options made $16, and in the put options I made 164. So basically just add them together and then subtract the commissions for them. So I'm going to add 0.5 for that and then subtract 0.26. Gives me 179. And if I multiply this by 1.29, which is the conversion rate, I get 232. So that's what I have here, 232. And that's the USD to Canadian dollars. This is the conversion rate. I'm just going to use the current conversion rate on the week and then not change it after that. So my goal with this challenge is to make $10,000 using $20,000 of capital. So that's a 50% return within 1 year. To make $10,000 in a year, I basically have to make $200 roughly on average every week. So pretty good start so far, and that's pretty much what I expected, other than the getting assigned those shares. So let's take a look at the stock price today and see what is going on. Okay, so this is a new week. Let's look at the daily chart. Turn on some candles here, and we are down just a little bit. We had a nice pop, and then now it's going down. Now, Alphabet reports earnings tomorrow after the market closes, so that will be quite interesting to see how they do. And because it's earnings week, one thing I can take advantage of is the higher implied volatility. And eventually, when the implied volatility falls after earnings come out, you're going to get IV crush. And so that number, implied volatility, is going to drop a lot. But why this is significant is because the price of an option, in other words, the amount of money I make from selling options, is going to be higher if IV is higher. So imagine I sell an option right now and I sell it at $100 with IV at 74. Once earnings come out and IV drops down to like 40 or 50, assuming everything else stays the same, that option might drop to like $60 or $70, right? So I just sold at 100 and I can buy it back at a cheaper price, which means I make like a $30 or $40 difference. So that's taking advantage of IV crush. And the reason why that happens is because right before earnings, the stock can move up and down and nobody knows what it's going to do. But after earnings come out and the stock price has time to adjust to the new fundamentals of the company, well, then it's probably not going to move as much. So that's why the implied volatility, the expected volatility, drops a lot after the earnings come out. And as an option seller, I want to take advantage of that. So normally I don't do this, but because it's earnings season, I'm going to be a little bit more aggressive with my options today. And in terms of the strategy I'm using, I think for this week, I'm still going to stick with the short strangle, which is same thing what I did last week. So once again, I will go to the chart and take a look at where do I want to have my put and call strike prices. If we draw a straight line, we're probably not going to fall below this horizontal line here, which is around 105. So I think that's roughly where I want to set my put price. And also at 105, I think Alphabet would be a bargain at that price. So I wouldn't mind picking some up and then writing covered calls on that and making like maybe like 5% a week because it's so close in the money that the options are going to be worth a lot if you sell it. In terms of the call strike price, if I use a measured move trend line here, we can see it when it goes up about 12%. This is the last pattern that we've had. And also for this one, it goes up about 12%. and this one as well, about 12% before falling. This one is the first one that actually broke, just up about 5% before falling. But if I were to take that same 12% pattern previously, because I want to know what is the maximum price that Alphabet can rise up to in the next 4 days. And so it looks like that's going to be around the 120 mark if it were to follow the same pattern. It might go up higher, but 89-day moving average is also around the 120. This is at 119. So that's a good indicator that maybe at least in the short term, and this is the good thing about trading weekly options, is at least in the short term, I'm probably not expecting a huge move up, even if the earnings come out really good. And if it goes above 120, that's cool because last week I bought Alphabet at 108. So if I get rid of it at 120, that's a $12 difference times, that's $1,200. And I'm trying to make $10,000 in a year. So if I make $1,200 in a week, then I've accelerated my goal. So it's not a bad thing. Something else you can look at, which is very interesting if you want to find out how much the stock price is likely to move right after an earnings report, is you can go to tip ranks and then you type in the ticker that you want. And then if you click on earnings and scroll down, there's this area here called the earnings history. And if you scroll down just a little bit below that, there is the earnings related price changes. So this tells you over the last 10 or so quarters what the price of the stock was right before earnings, and then what the price was a day after earnings, and what the percentage change is. So how this is useful is I can take a look at these percentage change numbers on the side and realize that in most cases, it looks like Alphabet does go up after it reports its earnings. And even if it misses, or for some reason the stock goes down regardless, it only goes down by like 2 or 3 percentage points, right? And when it goes up by 2, 3, 4, 5, 7. There's even an 8.89. So if we take the extreme of that, and if we take today's price of 107, and let's say it goes up by 9%, it'll end the day. This will be a Wednesday, one day after at 116. So that's not too far away from 120. So that kind of gives me another idea how far away I need to move the call option strike price. So I probably don't want to go below 116 just in case we get really good profits or really good guidance. I mean, that's not a bad thing since I'm an Alphabet shareholder, but for options trading, I don't want the price to go too high. Otherwise, I'll get rid of the stock. I want to keep the stock and continue selling call options on it. Now that I have a pretty good idea of where I want those strike prices to be, 105 for the put and about 120 for the call. I'm now going to go into the option chain here. This is for Alphabet, 4 days to expiration. Let's go to 105 here. So this gives me a delta of negative 37. So maybe I'll go 104 just to play it a little bit safe. And that's going to give me roughly a 1 in 3 chance of hitting there. And if I get a sign at 104, after you factor in the option premiums, if I do get a sign, I'll buy it at like 101 or something. That's what's cool about selling options is you buy it at the strike price, but you actually paid a little bit less for that, so you lower your ACB. Okay, so I'm going to turn on Strategy Builder here, which basically means I can put on multiple trades at once and create strategies. So a short strangle is basically a short call and a short put added together. So at 104, I'm going to click on this leg here, and that's going to add one leg. And down here, this time I'm going to go over to the call side. Oh, this is very far out of the money now. This is a 1.4 standard deviation. Not too bad. You can see the likelihood of that going in the money is less than 10%. Maybe I want to play a little bit safer because it is earnings week. Anything can happen. If the share price goes to the moon, then I want to make sure I capture as much of that gain as I can. So maybe I'll do a 121 because it looks like from 120.25 to 121, the bids and asks are pretty much the same. So I might as well go for the 121 and try to make around 25 to 30 cents there. So I'll click on the sell leg here. So now I have a short strangle at. So the difference between last week and this week is, last week it was 108 and 120. This week I've just basically increased that spread to have a wider range of closing prices that can expire out of the money. But even though I'm giving myself more wiggle room there, let's go with 2 quantities again. You can see I'm going to make a lot more money than last week. So if I go to the if I go to mid 228 and then just increase this a little bit to maybe like 235, or actually 230 is the bid, so I can't go over 230. So I'm going to go with 229. So if I submit this order right now, I'm going to make a lot more money than last week. So this is 458 in US dollars. And I'm going to use the same amount of capital, right? But make more than twice as much as before. So this is a pretty good, it looks like a pretty good return on the amount of money that I'm putting up. So 458, and we'll multiply that by the conversion rate. So basically make 590 Canadian divided by the maintenance margin of 79.28. So that's a 7.4% return, assuming I make 100% of these premiums. In other words, I don't buy back any of my options and they all expire worthless. Let's take a look at how likely that is to happen. If I click on profile, here is what the option will look like. So I have a 70% to make a profit. That's pretty good. 7 in 10 chance, and just under 60% chance of making a 100% return. So here are my break evens. One is at 101.8 and the other one's at 123.2. You can see it right here. So what this means is in the next 4 days, I want Alphabet to stay within this range from 101.8 to 123.2. So this looks like a pretty good profile. Looks like it's more likely to be profitable than last week. So I'm going to go ahead and put this order through. I'm going to take a look at what the price is now. Okay, so it's about the same. It's gone down a little bit. Let's go to 222, and I'll submit order. So if this goes through, what's going to happen after is I'm going to wait until tomorrow when Alphabet announces, and then on Wednesday, depending on what the stock price does, I might close my position early and get out, either because I think the price has moved way outside of what I wanted to and I don't want to lose too much money, because that would be like a worst case scenario where I'll be in a negative position and I'll be losing money. But the other reason is because Ivy Crush has been so successful that I've made the majority of the profits already, and because I don't want to take any more risk, I could close the position early with a profit. So let me lower this to, if I do 121, it might go through.
Order partially filled. Order filled.
So that is 2 short strangles at 221 each, and the short strangles are made of 104 put and a 121 call. So that's going to get added to my portfolio over here under combo. That's the new one here. I'm losing $4 so far. Let's see how it goes throughout the week. Anyway, thanks a lot for watching. I'll give you guys another update next week.